So how do you completely beat the Japanese stock market, outsmart decades of traditional financial wisdom, and still manage to lose like almost 55 points of your own value in a single afternoon?
Yeah, it's quite the contradiction.
Right. Today, we are looking at a highly classified log from Team AI Lab, and we're basically witnessing what happens when perfect mathematical logic meets absolute market chaos. So, welcome to the deep dive.
Glad to be here for this one.
Our mission today is unpacking this genuinely fascinating observation log. It's dated June 8, 2026. And, we aren't looking at some polished corporate performance report here.
No, definitely not.
It's a specialized tracking notebook. It's literally titled Kabu Notebook U.txt, which just translates to a stock notebook. And we're going to analyze how different artificial intelligence trading algorithms are, well, attempting to survive in a wildly unpredictable environment.
Well, before we go a single step further, we really need to establish the very strict boundaries of this particular log.
Yeah, that's crucial.
Because what we are looking at is a pure observation record. It is a clinical scientific look at algorithmic behavior and simulation results under very specific, highly stressed conditions.
Right.
So I want to be absolutely clear with you, listening to this right now, this is not investment advice.
Not at all.
We are not recommending buying or selling anything, nor are we, or the source material for that matter, promising any future profits. We are treating this exactly as the researchers at Team AI Lab treat it, which is
As a laboratory experiment.
exactly as an experiment. We are observing how distinct logical frameworks perform when the structural integrity of their environment is just completely compromised. It is a scientific look at logic under extreme stress. Nothing more, nothing less.
I like to think of it like we're researchers looking through the glass at two distinct species of deep-sea creatures, and they're trying to survive this sudden, incredibly violent change in ocean pressure.
That's a really good analogy, actually.
Thanks. And to understand how these algorithms in this pressure cooker are faring, we first have to understand their fundamental philosophies of survival. Because these aren't just random lines of code, throwing darts at a board.
Right. They represent two entirely opposing worldviews on how to navigate a volatile system. The simulation pits these two distinct living strategies against each other. On one side, we have Team Mountain Climbers.
Okay, the mountain climbers.
And their core operational philosophy is equilibrium detection.
Equilibrium detection. Okay, break that down for me mechanically, because when I hear equilibrium, I think of balance. But how does an AI look for balance in a stock market that is, constantly moving?
So, in the realm of algorithmic trading, equilibrium is often about statistical mean reversion and correlation.
Okay.
Imagine two assets that historically always move together. Let's say the price of copper and the stock prices of major housing developers.
Sure, because you need copper to build houses.
Exactly. If they are historically correlated, they are in equilibrium. So the mountain climber strategy scans the market for moments when that equilibrium breaks. Say copper drops, but housing developers don't.
Ah, I see.
The algorithm assumes this is a temporary error, right? An artificial distortion in the market. So it buys the undervalued asset, expecting the mathematical rubber band to snap back to its normal balanced state.
Because it always has before.
Right. They are seeking structural stability. They want the unmoving rock in a mathematically unstable environment.
So they aren't trying to fight the wind, they are looking for the heavy things the wind can't blow away.
That's a great way to put it.
Okay, so contrast that with the other side. Team Wave Riders, their underlying philosophy is surging force tracking.
Yeah, the wave riders operate on a completely different set of physics. They do not look for stillness, because their logic dictates that in a rough sea, stillness is actually a trap.
Wait, a trap? How so?
Because if you stay still while everything else is moving violently, you just get crushed. So they utilize momentum-based algorithms. Instead of looking for a rubber band to snap back, they're looking for a heavy object rolling downhill.
And they want to jump on it.
Exactly. They want to harness that kinetic energy. They're identifying velocity and volume, the sheer brute force of the market's movements. And they attempt to ride that momentum to their advantage completely, regardless of underlying fundamental valuations.
They don't care what the company actually does. They just care how fast the stock is moving.
Precisely.
Wow. Okay, so we have the seekers of stillness versus the riders of momentum. And the environment they're operating in right now, as of this June 8th, 2026 log, is what makes this so incredibly compelling.
It really is.
Because the data points to an abnormal reality. Let's look at the index contrast metric from the season standings. Team Mountain Climbers shows a positive contrast of plus 2.7 points against the Nikkei 225 and plus 1.6 points against the TOPIX. Meanwhile, Team Wave Riders also shows a positive contrast, plus 1.8 points against the Nikkei 225 and plus zero point 0.7 against the TOPIX.
Right, and just for some quick context for you listening, the Nikkei 225 tracks the top 225 blue-chip companies in Japan. And the TOPIX is an even broader measure of the Tokyo Stock Exchange.
The standard benchmarks.
Exactly. They are the standard barometers for the normal financial weather. And according to this log, both AI teams are mathematically outperforming that normal weather.
Okay, but wait. I'm genuinely confused here. I've looked at the rest of this log. Later on, we see that these teams are bleeding absolute points. They're taking massive, massive losses.
Yes, they are.
So how is a positive index contrast a win? I mean, a loss is a loss, isn't it? If an algorithm burns through its capital, telling me it burned through it slightly slower than Toyota or Sony, that doesn't sound like a victory to me. Why does this contrast even matter?
Well, in a standard market environment, your skepticism would be entirely justified. Like you said, a loss is a loss. But you have to view this through the lens of algorithmic survival and system diagnostics. This specific mathematical contradiction, where you're beating the index while sustaining heavy absolute losses, it paints a highly dramatic picture of the environment.
How so?
Because this massive gap between the traditional indices and the algorithmic performance isn't just some quirky accounting error. It signifies an abnormal state of emergency in the market.
You mean the baseline itself is fundamentally broken?
The ground is giving way beneath everything. If the algorithms are losing heavy points, but they're still outperforming the Nikkei 225 by 2.7 points, it tells us that the indices themselves are in a complete freefall.
Oh, wow.
The normal market is collapsing faster than the algorithms are losing. We are looking at a market where the historical rules have just totally changed. The storm is so severe that existing traditional financial logic is failing across the board.
Wow.
Both the mountain climbers and the wave riders are mathematically proving that the traditional benchmarks are taking on water faster than they are.
It's like saying you are the slowest sinking ship in a fleet that is actively going to the bottom of the ocean.
Yes.
It's a relative win, but an absolute emergency. And that brings us to the actual units deployed in this storm, because the laboratory doesn't just let the same algorithms run forever, right? They are constantly cycling in fresh logic.
They have to, yeah.
The log notes that today, at exactly 9.00 JST, the daily scouting was completed. They drafted what they call new talent into the active roster.
The 10-session trial by fire. Team AI Lab utilizes a very, very specific testing methodology.
Right, these newly minted algorithms are given exactly 10 trading sessions to prove their underlying logic. Today, 3 new units were drafted to join the mountain climbers and 2 new units joined the wave riders. But I find that 10-session time frame really interesting. It's not a single day, but it's also not a full quarter. Why 10?
Well, 10 sessions is essentially the sweet spot for statistical significance in high-frequency or algorithmic trading evaluation.
Yeah.
It provides enough beta points to prove whether a unit's micro-adjustments actually grip the current reality. Maybe it's a slightly different sensitivity to copper prices for a mountain climber, or a different velocity threshold for a wave rider.
Just giving them enough rope to prove themselves.
Exactly, and if the logic is flawed, 10 days is short enough to cut the unit before it causes systemic damage to the whole portfolio. By constantly injecting this new talent, the lab is basically iterating its survival traits in real time.
Like rapid evolution.
Yeah, but to understand the severity of this environment, we need to look at the main force. That's the active roster of units currently serving out their 10-session tenure.
And the data on the active roster is incredibly telling. Let's start with the Seekers of Stillness. The mountain climbers currently have 11 active units deployed. Astonishingly, out of those 11 units, 7 of them are holding positive points.
Which is wild. 7 out of 11 in a collapsing market is a remarkably robust survival rate.
It really is. Now look at the wave riders. They have a larger active roster with 16 active units currently deployed. But out of those 16, only 5 are holding positive points.
Just 5.
You have 16 algorithms designed to ride the momentum, and only 5 are actually keeping their heads above water. You know, looking at these numbers, the 7 mountain climbers and the 5 wave riders holding positive ground, I see them as like lighthouses in the dark.
That's a good visual.
You have an environment that is swallowing almost everything else whole. Traditional indices are plummeting, the absolute scores are dropping, the majority of the momentum-based units are underwater. What are these miracle adapters seeing in the confusion that all the other algorithms aren't? Like, how are they surviving?
Well, we break down the mechanics of those 7 positive mountain climbers. It means their specific parameters for equilibrium detection found a genuine functional anchor.
An anchor in a storm.
Right. In a market where almost everything is being violently repriced and historical correlations are just breaking down left and right, these 7 algorithms located sectors or specific data pairings that remain structurally sound.
Do we know what kind of sectors?
The log doesn't specify all of them, but perhaps they found a correlation in defensive sectors, like utilities or essential consumer goods, areas where the rubber band of mean reversion was still snapping back exactly as mathematically predicted. They found the rare, unmoving rock in the landslide.
That makes sense. People still need electricity and groceries even if the market is crashing.
Exactly.
And what about the 5 positive wave riders? I mean, if momentum is literally destroying the other 11 units, what are those 5 doing differently?
For those 5 wave riders, their surging force tracking managed to successfully filter out the market's destructive noise.
The noise.
Yeah. In high volatility, prices whip back and forth violently.
Right.
And that creates false signals of momentum. Most momentum algorithms get chopped to pieces, buying into fake rallies that immediately reverse.
Oh, I see. They think it's a wave, but it's just a splash.
Exactly. Those 5 successful units likely have superior velocity filters. They managed to identify a current that wasn't a deadly undertow. A genuine, usable wave of directional momentum amidst a sea of erratic volatility.
But this raises the ultimate question, doesn't it? What happens when the underlying logic of a unit finally breaks? Because these 10-session trials do eventually end,
They do.
and the final scorecard section of this log reveals the true brutality of the current market. This is the exit log for the units that completed their mandated tracking protocol today. Their trial is over, and the final marks are in. For the mountain climbers, the units that exited today were operating specifically in the construction and non-ferrous metals sectors.
Right.
And their final total score for the 10 sessions was a brutal minus 29.5 points.
Which is a severe rejection of their equilibrium thesis in those specific sectors.
A total rejection. Let's dig into the why of that rejection. They went looking for stability in construction and non-ferrous metals. Mechanically, why would equilibrium detection fail so spectacularly there?
Well, let's use our earlier example of correlation. Historically, non-ferrous metals like copper, aluminum, and zinc, they move in lockstep with the construction sector.
Right. If you're building houses, you need copper wire. You need aluminum fixtures.
Exactly. The algorithm's logic is built entirely on that dependency. So if construction demand is stable, but copper prices suddenly dip, the mountain climber buys copper, assuming the price will revert back up to match the construction demand.
Because it always has.
Right.
But at minus 29.5 points, that rubber band clearly never snapped back.
It didn't just not snap back, it snapped entirely. What likely happened in the real world? Perhaps a massive unexpected supply chain shock or maybe a sudden geopolitical tariff? It caused copper prices to decouple entirely from domestic construction demand.
Oh, wow. So the relationship itself was severed.
Yes, the algorithm kept buying the dip, fully expecting the historical equilibrium to restore itself. But the mathematical reality had permanently shifted. The correlation was dead, and the algorithm just bled points, waiting for a return to a normal that, well, it no longer existed.
That perfectly illustrates the danger of relying on historical stillness. The rock you are holding onto gets thrown off a cliff.
Pretty much.
Now, let's look at the wave riders who exited today. They were operating in retail trade, and their final total score for the 10 sessions was minus 2.9 points.
You know, comparatively, a minus 2.9 seems almost like a gentle landing next to the climber's minus 29.5.
It really does. You see a minus 2.9 and think, okay, they managed to scrape by with minor friction losses. But then you pan out. You look at the aggregated season standings for the entire teams rather than just the exiting units.
And that's where it gets ugly.
That's where the true devastating scale of today's market conditions reveals itself.
Yeah, the season scorecard is where the simulation data becomes truly stark. Let's start with the mountain climbers' aggregated season metrics. They entered today with a carryover balance of plus 19.8 points.
So they had a solid cushion built up over previous sessions.
They did. But today alone, their daily score was a hit of minus 12.1 points. This dragged their total season points down into negative territory, sitting at minus 14.9 points.
So the stability they were looking for across the board just fractured today. They lost a massive chunk of their accumulated season value in a single daily session.
The mountain climber's loss is significant, but I mean, it pales in comparison to the absolute mechanical catastrophe that struck the aggregated wave riders today.
Yeah, this part of the log is genuinely shocking. The Wave Riders came into today looking like absolute champions. They had a massive carryover balance of plus 56.6 points.
They were dominating the simulation.
Completely dominating. They had successfully harnessed the surging force over previous sessions and built up this fortress of positive points, and then today's daily score hit.
A staggering, breathtaking minus 54.9 points in a single day.
Wait, minus 54.9 in one day. It wiped out almost the entirety of their season's hard-fought games in one fell swoop. It crashed their total season score down to a bleak minus 34.5 points.
Just complete wipeout.
Think about the mechanics of surging force tracking, like the adaptive cruise control on your car. But instead of just maintaining a safe speed, this cruise control aggressively accelerates whenever it feels the car rolling downhill. It wants to maximize efficiency. It's highly effective when the road is relatively smooth and the hills are predictable.
But today's market wasn't a predictable hill.
It was a sheer cliff. The algorithm felt the sudden, massive downward momentum of the market, and it interpreted that drop as a powerful new force to harness. So following its logic perfectly, it pushed the gas pedal to the floor to ride that momentum.
And drove itself right into a 54.9 point collapse.
Exactly.
That analogy really captures the fatal risk of momentum trading perfectly. When you attach your survival purely to velocity, you are entirely unanchored. Equilibrium detection, the mountain climbers, they suffered today because their anchor slipped.
Well,
They took a minus 12.1 point hit.
right.
But because they were looking for a baseline, their algorithms eventually stopped buying when the deviation became too extreme. They had a built-in brake.
The Wave Riders don't have brakes.
No, by design, they do not have brakes. They have sails. When the market experienced a violent, rogue surge, they absorbed the full, absolute kinetic energy of that crash. They bought into the sheer momentum of a collapse.
It really highlights how quickly the rules of the game can flip. I mean, you can be winning the season, riding this massive high of plus 56 points, and one abnormal market session where the physical rules of the road change just resets the board completely.
It does.
But here's the thing that really stood out to me about this entire log from Team AI Lab. You read through these numbers, the decoupled sectors, the massive 54-point collapse, and there is zero panic in this text. There are no exclamation points next to that massive loss.
And that is perhaps the most crucial takeaway from this entire observation. It really speaks to the core of Team AI Lab's methodology. We need to understand their cold, forward-looking research posture.
Yeah, explain that, because normally people would be freaking out.
Oh, absolutely. To a traditional participant in these markets, a human trader or a standard portfolio manager, a sudden drop of 54.9 points is a terrifying defeat. It is a disaster that results in panic selling and, frankly, fired managers.
Right.
But in the realm of pure algorithmic research and logic simulation, these severe daily losses are not a defeat at all.
They are just data points.
They are highly valuable boundary mapping observation data. In scientific research, a catastrophic failure of a system under stress often provides significantly more useful data than a long period of easy success.
Because you finally see where the edges are.
Exactly. When the Wave Riders suffered that massive 54-point wipeout today, the algorithms didn't feel fear. The researchers reviewing the Kabu Notebook U.txt didn't panic. They simply recorded the precise environmental parameters, the exact velocity thresholds, and the specific market conditions that caused the surging force logic to drive off the cliff.
It's the exact data they need.
Because tomorrow at 9.0 JST, the draft happens again.
The iterative process continues.
Always. They are maintaining a completely objective scientific posture against a vast, unknown, and highly volatile market environment. Today's severe losses are simply the cost of mapping the boundaries of a new reality. They are discovering exactly where the current logic breaks, so that tomorrow's new talent can be calibrated to survive it. They aren't trying to win every single day. They are trying to evolve a fundamentally superior logic over time.
They are mapping the boundaries of a new reality. That is a fascinating way to frame it. And as we wrap up this deep dive into the June 8th logs, I really want to connect this back to you listening to this right now.
Oh, definitely. There's a human element here.
Right. We aren't AI trading bots, but this observation log is fundamentally a masterclass in adaptation. We all operate in complex systems with changing pressures. Maybe it's your industry suddenly being disrupted by a new technology that, well, decouples the old ways of doing business.
Like the copper in construction.
Exactly. Or maybe it's a sudden shift in your career path, or a macroeconomic shock that changes the rules of your specific profession. The market of your life will inevitably experience a severe storm.
And when that storm hits, you are faced with a similar strategic choice. Do you seek equilibrium, looking for the foundational skills and relationships that won't change? Or do you try to track the surging force, harnessing the chaos of a new trend to propel yourself forward?
Yeah.
Both have merits, and both, as we saw today, carry profound risks when the rules of the environment fundamentally shift.
And more importantly, how do you react when your chosen strategy fails mechanically? When you take a massive hit, when your carefully built momentum drives you off a cliff, or your reliable anchor suddenly snaps, do you panic at the losses? Or do you adopt the cold, objective posture of Team AI Lab?
Treat it as data.
Exactly. So I want to leave you in a final thought to ponder today. When the normal weather gauges of your own life stop working and your usual reliable strategies suddenly fail, are you desperately trying to win the day and lamenting what you lost? Or are you calmly logging the boundary mapping data you need to survive the next decade? Something to think about as you navigate your own waves and mountains. Until next time.